Hello, I'm Donna Sawyer from the Finance News Network, and joining me from fund manager Ausbil is Director of Equities John Grace. John, welcome back to FNN.
Thanks, Donna. Nice to be here.
The recent reporting season has been and gone with mixed results. How did Australian companies fare in your opinion overall?
I think mixed is a very good description, Donna. A lot of companies did quite well, depending on what sectors they were in, particularly industrials. Other sectors didn't go so well, such as resources, but overall the market had another year of relatively flat earnings.
How did mid-cap stocks compare to their smaller and larger peers?
Overall, the economy's been fairly indifferent for companies. The larger cap stocks were very aggressive in cutting costs in a low sales growth environment and therefore beat expectations in general. Smaller cap stocks didn't really have to cut costs as aggressively as the larger cap stocks and were therefore looking for more growth options and generally performed better in our view.
The market has rallied quite strongly since we last spoke. That said, we have seen it dip to 4,600 this year. Do you think the worst is behind us now, or is there still a degree of caution lingering?
Yeah, the market's viewing things a little bit more optimistically at the moment, and that's leading to some PE expansion. So we are waiting for the earnings to come through as economies recover. But things are still slightly cautious, but overall on the improve.
What's your outlook for the market now that we have the certainty of a newly elected federal government?
The market's picked up quite nicely since the federal election, rising about 4% since that date. Overall, companies seem a little bit more positive with regards to capex plans and expansion plans, and you can see consumer confidence numbers starting to come through as well. So overall, we're a little bit more optimistic on the outlook for the equity market.
Now to your Australian Emerging Leaders Fund, which sectors is the portfolio overweight in?
Given our more optimistic view on markets, the portfolio is more cyclically positioned, so those stocks will benefit from an improving economy such as retailing, such as media and consumer-related services. In addition, as the market performs well, those sectors linked to the market, such as banks and financials, we are also overweight in.
Okay, so which sectors are you underweight in?
We're underweight defensives as a result of our more optimistic view on the market, so underweight REITs, utilities, healthcare, etc.
In the Emerging Leaders universe, what have been the best performing sectors over the past 6 months, and how is your portfolio weighted to capitalise on that?
The last quarter has seen quite a big rebound in the resources sector, particularly small resources and sectors such as gold. The portfolio is not well positioned in the gold sector, being a nil weight, but we have some really good selections in the small resources sector. The portfolio has done well there. In other sectors such as media and retailing also had a very good quarter, and the portfolio is overweight both of those sectors with some really high quality stocks rallying well with the market.
At a stock level, what were the largest contributors to your performance?
With the market performing quite strongly, those stocks related to the market have done well. Stocks such as Henderson Group have been performing exceptionally well, and in the banks, our big position in Bank of Queensland has also been a big contributor to our performance. In the media sector, our overweight position in Seven West Media has also been performing quite well. Our position in Fairfax has been a little bit disappointing, but we're expecting bigger things from that in the next quarter or two. And in the retailing space, JB Hi-Fi and David Jones have done exceptionally well for us in terms of relative performance.
So what were the biggest detractors over that period?
We've had two stocks that have been frustrating us a little. The first one is BlueScope Steel, which did not have a great result at the August reporting period, but the stock is well positioned for the next 12 months as global growth picks up, and particularly well positioned in the housing cycle, which is showing some good improvement. The second one is Macmillan Shakespeare, which suffered a drop coming up to the election with potential changes to fringe benefits tax. The stock has subsequently had a bounce as the election result came out.
How has the fund performed relative to your benchmark over the past year?
The fund's had a cracking 12 months, up over 30% relative to the benchmark of just over 15%.
What key changes have you made to your portfolio?
With the market starting to improve, our confidence is starting to rise with regards to the outlook, as mentioned earlier. We've added to some more cyclical positions in the retailing, such as Harvey Norman, which will benefit from a better retailing environment, but also a better housing environment. Likewise, our confidence is rising in Bank of Queensland as new management starts to take control there, and we've added to that position, such that it is now the biggest stock in our portfolio.
What are the risks you're considering right now?
Yeah, global risks are always present. What we really want is the domestic economy to get some confidence and start picking up, because we really need earnings to start following through as the market has expanded, i.e. PEs have expanded, so we really need the earnings to follow through, particularly in those cyclical sectors.
Finally, John, what is your outlook regarding corporate activity over the next 12 months?
I'm pretty bullish on corporate activity over the next 12 months. Balance sheets are in great shape, interest rates are at record lows, and management is starting to look at some growth optionality, so I do expect some takeovers to start coming through. In addition, IPOs are starting to hit the market as well as investors a little bit more bullish, so we can see a few more of those over the next 3 to 6 months in particular.
John Grace, thanks for the update.
Thanks, Donna.